John Higgins, Mortgage One. Happy Monday. So the news over the weekend, obviously front and center with the United States striking the nuclear capability of Iran. That has the markets a bit in a seesaw battle. We did see overnight that the stock futures were heading south, but they have recovered, and that has really helped out interest rates as well, shockingly, because any disruption to oil from the Middle East could be inflationary. At the moment, the market is kind of shrugging off the news and improving a bit on that. We'll have to watch as we move forward. There's been a ton of cross currents, obviously, over the last year or two, and geopolitical events also are one thing we have to keep our eye on. But let's recap what happened last week. We mentioned that the Federal Reserve had their open market committee, and as we kind of called, there would be no change in the Fed funds rate. What's interesting is that the Fed chairman did call for 2 rate cuts this year, while at the same time saying that the Fed is well positioned to wait on cutting interest rates. So a lot of it, I think, is data dependent, and we'll see in the last 6 months of the year. It'd be nice if we could get 2 rate cuts. That would certainly, I think, help out home affordability. But let's recap what the Fed sees. They're seeing unemployment increasing, which is not necessarily good. We need people with jobs to buy homes. They're also calling for the GDP to slow from 1.7 to 1.4%, so not a good call there either. And the Fed's favorite gauge of inflation, the PCE, they see it increasing to 3.1%, which is interesting because we've been seeing the last couple months, as we gave you in the update last week, that inflation at the moment is slightly subdued. What the Fed is worried about, obviously, is tariffs and all the impact that will be hitting in the second half of the year. Where are we now on the 10-year Treasury? Well, we know that the battle to stay below 4.5 continues, and at the moment, we're closer to 4.2, which is kind of our next line in the sand. Certainly be nice to get below that. We'll take the lowering of the 10-year Treasury coming off some really wild geopolitical news. Take it when we can get it, certainly. What does that mean for our mortgage interest rates? Well, Freddie Mac's market survey shows that last week interest rates ticked down 0.03%, so heading in the right direction, but not really a big move. Home affordability is still an issue as interest rates hover close to 7%. I wanted to mention a program that's out there. We've spoken about the down payment assistance program for our first-time home buyers in the last couple updates, but there is a program out there for sophisticated investors. It's called our debt service coverage ratio, or DSCR mortgage. And what makes it interesting is we qualify only on the rental income. I won't say it's a no income verification loan so much as the income that's generated from the rental is how we qualify our buyer. If you find that some of your investors, because they've been acquiring property rapidly, are a bit tapped out on their debt to income ratio, well, this is a great program to get them in without having to disclose any W-2s, looking at pay stubs, and their self-employment income and all that. This is a fantastic program. It's quick and easy. We get an appraisal, gives us a rental income for that property. We compare it to the principal and interest, taxes, and an association fee if it exists. If we maintain a 0.7% coverage ratio or 1%, we have a couple different programs. Interest rates better, the higher the coverage ratio. We can get your buyer into that investment property and start generating some passive income. Would love to get your investors qualified on this. It's a unique program, certainly offers lots of opportunities for those very active and aggressive investors. We'll give you an update next week after we get more information on inflation through the PCE. Until then, stay cool.